Welcome to episode 42 of Accessible Finance, where we demystify personal financial topics and answer your
Why'd you
questions
laugh?
so you leave saying, I get it now. I'm Eric Johns.
Why'd you laugh?
Because it's funny to me that we're
Still have to
42
laugh.
episodes
Okay,
in
okay.
and I don't actually know the intro. I don't have it memorized. I didn't commit it to memory.
And I'm Rachel Johns.
Let's dive in. This is awesome. This is the best start to an episode ever. Edit nothing.
Okay, done.
Let's
Done.
go.
All right. So we are at part 4 of our retirement series, Eric. So far we have covered when can you retire? How should you start withdrawing money from the accounts, Medicare and IRMA brackets. And so finally, in episode 4, this series, we're discussing asset allocation and how it should change as you get older.
Mhm.
We've all heard the line, right? That obviously, as we get older, we need to start pulling everything out of stocks and putting it into bonds, right?
Mhm. Yes,
Yeah,
that's what we should do. That's it.
yeah, done.
That's a wrap. Let's go.
Episode
I think we're
3.
going swimming after this. This should be fun,
Yeah,
guys.
let's do it.
I'm kidding.
That's what we hear now
It is what most people tend to think about, right?
and what we're told, right?
Correct.
Yeah.
Correct. The
Who
short answer
disagree?
to how much should my asset allocation change in retirement is it depends, right?
Love that.
Yeah, no one loves
So
that, right? So
comforting.
let's talk at least about a little bit about what it depends on, how you should think about it, and those kind of things. So we typically hear, like Rachel just said, we should just throw all of our money into fixed income.
Yeah.
We were investing in equities, and you just, you subtract your age from the amount, like 120, and that's your percentage in equities, something like that. Like
Yeah.
that's
Yeah.
that's typically what people would say. But that's one of the methods. There's like
They
infinite
have a bunch
methods,
of
right?
rules of
But typically what
thumb.
happens is you say when you're younger, you have a larger percentage in equity, and when
Right.
you're retiring, you have a larger percentage in fixed income.
Right.
Okay. And while we're not disagreeing with that, like
Premise.
correct, we're not disagreeing with the premise. We're saying that it might be marginally overstated, at least for you. Okay. So if you are entirely risk averse and you believe and you can substantiate all of your income needs with fixed income in an environment where you can guarantee that like buying individual bonds or the market fluctuations won't impact you, sure, go ahead. Go ahead. If you have no, like there are different things to solve for here. And the only cautionary tale is that we'll hear a lot of people say, like, put me in a bond fund, right? A mutual fund or an ETF
Hmm.
that owns a bunch of bonds because there's no market risk there. I'm not subject to any kind of market risk. That is not true.
Yes.
That isn't accurate because when the Fed, essentially, right, like the federal bank, raises interest rates, okay, when they have FOMC meetings and raise interest rates, the price of your bonds that you have outstanding would go down. And what that means is when you own a basket of those bonds, they go down, right? So your ETF or your fund is going to be worth less if you have to sell it to go and buy things with dollars because you need to eat,
And
right?
well, exactly. And the thing is that once you're in that retired phase, your time horizon is now, right? So like you are in a position where you have to sell stuff because that is the source of your income to live on.
Right.
Um, and I do think that we've had clients come to us with the understanding that bonds are risk free,
Right.
right? Like they'll come and
They
say,
treat it like it's cash, but
correct.
it's not.
It's cash that gets a decent interest rate, is the
Correct.
belief, right?
You have to
And
tie it up for a
so,
period of time.
correct. And so I think that the overwhelming sentiment that we tend to receive initially is that bonds are a less risky version of the stock market with only the upsides,
Hmm.
right? That it won't go down. So, like, worst case, I get to keep my money, right?
Right.
But then there's an upside of something, more than like a savings account.
Right. So yeah, typically, there are a couple risks, right? Like there are two primary risks when you're just talking about investing in bonds, right? One is purchasing power risk. When I invest in a bond, like just simply speaking, let's assume that I buy a bond. Let's assume I buy like a 3-month treasury. Okay, I'm gonna pay. Let's say I have to pay 100 grand. All right, they're gonna pay me the 5% current rates, right? And then I'm gonna get that. I'm gonna get the 5K over. Well, I'm gonna get the equivalent of like 5K divided by 4, right? Because I'm only in 3 months and not a year. But
Right.
the idea is I'm gonna invest it. I'm gonna collect the interest, and then I'm gonna get back my $100,000 that I put in. When I get back the money that I put in, right? When I earn my principal back or get the face value at redemption, it's going to be worth less than 100 grand 3 months prior.
So, for
When I put it in.
example, $100,000 today is going to be worth less than $100,000 3 months from now.
Yeah, it'll be worth less than $100,000 tomorrow,
Yeah.
right? Like the inflation rate is going to be marginal in the short, like in day to day, but over time, right? We're
It's
still
right.
at like a 4% a year. So
Yeah.
It's not something you really want to just overlook and pretend that, there's no risk in that investment, right? There is the risk that the money that you get back is not going to be, hey, is not going to be able to buy the same amount of things that it could when you put it in. Okay, that's one. Then we talked about market risk,
Hmm.
right? So the bond market will move based on interest rates, and it's not just the interest rate movement itself. It's based on market expectations of what the Fed's going to do in the future, right? So there are sites you can go to where you can look at how many rate cuts the market's priced in. So like Jerome Powell is not coming out and saying we're going to cut 3 times this year or 4 times this year, right? At the beginning of this year, we thought that there were going to be like 3 to 5 cuts,
Yeah.
and now they're thinking maybe one. Okay, why is that? Did Jerome Powell say there were going to be 3 to 5? No, it's like the language that they use and all the market metrics. Like everybody's monitoring this stuff. It's analysts that are pricing, that are using futures. They're buying and selling futures, and we're taking those futures and looking at a projection. Sorry, didn't need to go into that much detail, but the point is that it
Seeing that there is a
moves.
better way to do that.
What?
Like
In
we're
futures markets?
yeah.
Are you critiquing futures markets?
Yes.
Sorry, that's
It
that's
just
that's but
it's
that's
very unsettling. Like I think to the layperson, right? It's unsettling that we are
betting on this essentially.
yes.
I mean, that's
Yes. Well,
welcome to
it's but
markets.
no. But I think it's unsettling insofar as the fact that like the general sentiment
Yeah.
um for people less familiar with the financial industry is that bonds are safe. So the
Okay.
thought process or the knowledge that bonds are factoring in estimates of all sorts of things, or that there's this much betting happening behind the scenes, I think is something that could change the sentiment of certain people that are believing that
Okay.
bonds and
Sure,
stocks
sure,
are
sure.
very
So
different.
to be clear, yes, that is correct. There are a couple things. There are a couple points that we should kind of iterate on or elaborate on here. So one is that not bonds are not you know monolithic. Like there's not just bonds. There's short term bonds.
Sure.
There's long term bonds. There's government, corporate.
Muni bonds.
Yeah. So each bond is going to have a different risk profile, and they're going to have different movements based on like market risk. Like they're going to have different exposures to things like market risk, default risk, everything else. So short-term bonds, right, are going to be less likely to move, or they're going to move with a lower magnitude than longer-term
Hmm.
bonds, all else equal. Like essentially, the longer the duration, the greater the movement of the price when the interest rate moves. Duration is a function of time to maturity, so length of the bond,
Sure.
okay, and then the coupon payment. All
Okay.
right, so the higher the coupon, the lower the duration, all else equal.
Okay.
The lower the coupon, the higher the duration.
Okay.
I'm sorry, the lower the duration.
So let's bring it to something tangible-ish. I'm 60,
Okay.
right? My risk profile is, let's say, 80/20,
Okay.
right? So that's
At age
why,
60, so you're pretty aggressive. Okay,
yeah.
I'm with you. I like it.
So
I would get along.
I was 90/10 in my younger years. I'm
Got it.
now at kind of like an
We're
eighty
all right.
twenty
We're still comfortable with 80% in equities.
as of now, but I'm
Got it.
not retired yet.
Okay.
Okay. I'm looking down the line at
Sure.
retirement, and everyone's telling me that I need to change it drastically, that I almost need to
Got it.
flip it. Right.
Okay. Yeah, yeah, yeah.
Um, so is it something that, like, how dire is the need to switch from 80/20 to 20/80?
Got it. How
Is that
should it be
how I
done?
should be thinking about it? Should I tier or gradually switch it? Is it something that I should just like press a button and just go? Um,
I like this. I mean, these are great questions.
Thank you.
Wow.
You're welcome.
I'm impressed.
But legitimately, so like if I'm somebody who's looking down the pipeline, I know that my risk profile needs to change because essentially all of my eggs are now in this
So
basket.
that's a really interesting statement you just made.
That my
I
risk profile,
know that my risk
yeah,
profile needs to change.
yeah.
Does it?
So I would say that conventional wisdom would tell me yes.
Okay.
Even if I personally, right, like I'm clearly relatively comfortable
Yeah,
with risk if I was 90/10, now I'm moving to 80/20. But as I see the time horizon as being shorter and being less tolerant of being able to handle like the, I don't know, 8-year dips in market and things
sure.
like that, um, I think I'm just acknowledging the fact that I need to be able to just sustain my lifestyle that I'm
Okay.
planning to have.
Okay.
So I don't really know how much merit to put into this idea of like flip-flopping my
Mhm.
um, allocation. I don't know if it's something I should be doing gradually.
Got it.
Um, I don't know if it's something where that would be too significant and I should maybe go closer to like 50-50 or 40-60? Like,
Right.
what are the things I should be thinking
So
about while I have time to make
So
those
the first
decisions?
things, like we talked about this in the first episode on retirement, how it all begins with cash flow, right?
Yeah.
Like it's all about how much money you need and how you're generating the income for you to live on, right? You used to get wages, you used to get W-2,
Yeah.
whatever, K-1. Now you don't. Now you have to support yourself from your investment accounts, okay, and retirement accounts and everything else. How much of that do you actually need? How much is Social Security going to cover? Do you have a
Yeah.
pension? Okay, let's assume that Social Security is going to cover, I don't know, like maybe your income need, your spending needs 100K. Social Security is going to cover inflation adjusted 30.
Okay.
We've got to
So
bridge a
that's it.
70K gap.
Okay.
All right. So we've now got to construct a portfolio where we can produce either 70K in income or we can take distributions
Right.
from our accounts. We got to come up with some kind of an idea
To
to get
replace
you
that.
70K
Yeah.
a year, right? Whether like there are a number of strategies. We talked a little bit about that with the withdrawals. Like
Yep.
how exactly can you do that? How do
Yep.
we think about that? You can, you could buy dividend stocks. You could have synthetic dividends. You could buy an annuity. You could
Mhm.
have bonds that are gonna issue coupon payments to support the 70K. So we
Correct.
have to discuss what you're actually comfortable with. We have to construct your income stream and talk about how we're going to make that money happen. So what are some of the factors that would steer us in one direction or another, or should potentially steer listeners in one direction or the other?
Correct.
How much money first, how much risk am I comfortable with?
Right.
Right? Like, and the first thing I would say is how comfortable are you shifting your spending? If we need to tell you, okay, look,
Yeah.
markets are way down. Can you, instead of needing 70K this year, can we give you 50K? Is that acceptable?
Mhm.
If your answer is yes, it's going to look a lot, we're going to have a lot more comfort with like an equity exposure than if you said, absolutely not. I need that 70K and that's the low end, right? Like
Yeah.
I need more, I might need more. Then we're going to be thinking, okay, we need fixed income, we need coupons that are going
Dividend.
to produce this, or possibly an annuity. The
Yeah.
other thing is, what are my estate considerations? Do I actually want to leave money to my kids?
Right.
Like how much of that, you know what I mean? Like how do I think about that? Right. Like so if I've got my income covered, essentially we can build a portfolio and then you can have an excess amount. Like
Yeah.
so there are gonna be some people that are gonna want like maybe even an annuity,
Right.
right? Like they're gonna want some guarantee that they're gonna get this money for their life. And then everything else they might be willing to let it ride
Right.
because it's the kids' money, right? Like or it's the grandkids or whatever
Yeah.
they're gonna do. All right.
Yeah.
But we want to think about your estate. So obviously, the higher the need for or desire for estate considerations, like I want to leave a large legacy to either a charity or my
Yep.
kids or something like that, then the larger the equity exposure there. Um, it depends on it really depends on what's going to be able to help you sleep at night. Like I think I've said this before,
Yeah.
but in a simple path to wealth, I think it's Jail Collins said if you're going to react in a very adverse way
Yeah.
when the market drops. So if the market drops 20% and you're going to sell, it's doing you no good to be in equities like at all. Right? Like
Because we all
don't
need
do
to
it.
accept the
Yeah,
premise,
just
though, there that selling in a down market is
is
terrible.
not good.
Right.
But some people are just going to they're just going to be compelled to do it.
Yeah.
And if you know that about yourself, well, okay, good.
Avoid
That's a good thing. We
putting
want you to be
yourself in a
self-aware.
position
Right. Don't put yourself in a
to
position where
make
you're going to be
yourself out to
selling
work. Yeah.
when the market drops because
Yeah.
the
Yeah. Yeah.
markets will drop. It's not a question of if they drop, they will drop. They drop
Correct.
intermittently in the weeks and they're going to drop significantly over time.
And that's what's
They're going
so
to go through
difficult, I
cycles.
think, because as you may be very risk tolerant, but as you get older and realize your time horizon is
Mhm.
shorter, you may become significantly less tolerant of a
Right.
drop for.
Right. And one of the things I briefly touched on the different types of bonds and everything. You can put a lot of your allocation. You can put maybe 2 to 5 years worth of spending. Some people will go as high as 10 years of spending if there's higher net worth clients and they have the extra dollars to just tuck away. You can put that in like a money market fund
Mhm.
where you won't get less than the dollars you put in. So it doesn't matter if the market moves. You're still going to get in, or you're still going to be able to pull out what you put in.
Yeah.
Does that make sense? So you can do that. Things like high yield savings account, money market funds, very short term bonds are going to move, but they're going to move less. Okay. Or you could just hold individual bonds and you'll still get the principal, assuming there's no default.
Mhm.
I'm sorry, I said principal, but I mean like face value, same thing, really. The money that you put in, you're going to get out at maturity, right? So there are ways we can.
Okay. So imagine that I'm
Too
my
much talking. I got you.
no,
Loud and
no,
clear.
no. Imagine I'm my 60-year-old person.
Yep.
So far, what you know about me is I went 90-10, I'm 80-20. I come and I say, look, I listened to this podcast. I listened to this news station.
Uh-huh.
It says I need to switch my stuff
They
to
told me I was wrong.
2080.
Right. They told
I
me I was
need your
objectively
help.
incorrect.
Yes, I need
The
your help.
first,
What
yeah,
are you going to tell me?
I would challenge the premise. I would say,
Okay.
let's have a conversation.
Okay.
Okay. What are we, what's Social Security going to provide? Well, we've established
Social
that the Social
Security
Security is giving you
30.
30K.
Yep.
We need
I
to
need
provide for
70.
70K.
Yes.
right? We would talk about what your living situation's like, what you want your retirement to look like.
Yeah.
How sure are we that this expense level is reasonable?
Right.
Right?
Okay.
We're trying to build that picture. We're not going to ask you because you're going to, you probably have some idea in your mind
And this is where
that
being
we're
able to
looking to
have the
be.
cash flow analysis to see do the numbers match what's being told to us,
Correct.
because it's
That's a
very, very
huge
easy
deal.
to believe you're spending one thing and then just not be.
That's
It's not intentional,
correct.
like, misrepresentation. It's just a genuine, I don't really know.
Right.
And that's okay.
Right.
Not everyone is like dialing in
No,
on
very few
the
people want
daily
to spend
budgets.
30 minutes to an hour a
Mhm.
month doing their budget and, balancing checkbooks and
You
everything
love
else.
it.
It is fun.
But but yeah, so okay, imagine that, like,
It's a lot less fun. Yeah. When
my
you're losing, it feels bad. When you're winning, it's
60-year-old
good.
me has said, I'm married, whatever.
Okay.
Yes, 70 is what I need. Ideally, like, that is this, I want to
We
spend
talk
money with
about
my
when you're going to
kids.
retire, when you're going to hop on Medicare,
Okay.
right? So, like,
Let's
what
say we're
kind of,
planning at 65.
okay, 65
So we have
retirement
5
and
years
Medicare.
away. Yeah.
Got it. All right. We're 5 years out. We're going to think about where the money's located, like what kind of retirement accounts it's located in. Is it
Hmm.
all in a 401k? Is it in tax
Okay.
deferred? Is it tax free? Do you have any in Roth? Is there going to be a separation from service before 65? How are we going to fund the income between 65 and RMDs kicking in?
Yeah.
Just in 73 or 75 or whatever, the RMDs are going to be when you actually have to incur them.
Yeah.
So we're going to think about it that way. Most of the conversation though is going to be tilted around your risk
Yeah.
tolerance. Like, do we need to own, like, are you comfortable owning like any Nvidia, right? Like, not that we would ever buy an individual stock, but if you're in the total market right now, a large percentage of your ownership, even if you're VTI or
Large
VOO,
cap.
right, a large broad US market ETF, you're still going to be owning a significant portion of three companies:
Yeah.
Nvidia,
Apple.
Apple, Microsoft.
Yeah.
Like, that's what you're going to be owning a lot of, right? So
All the
it's just a
Amazon.
question of, like, do you have that kind of tolerance? Do you have that kind of an
Right.
appetite? And if the answer is no, that's okay. Like, we could find some kind of large cap value or something that you could,
Yep.
find more palatable
Main takeaway here, more than anything, is the fact that, like,
conversation tonight.
yes, that you are gonna be able to come across articles, podcasts, whatever, to further whatever narrative makes you feel most comfortable. But it doesn't mean that it's what's best for you. And I
Yes.
think that trying to look at a good rule of thumb in this situation is such a huge mistake, because it's such a highly personalized situation.
Right.
And so you may have been told, okay, you've got to, like, flip it, right? You may need 20 in stocks and 80 in bonds, right? And that could be correct for you.
Mhm.
But if your risk tolerance up till now has proven that that's not
Right.
you, it may not be what you need to do.
Right. Or like you've heard the 60/40 like retirement, right? When we talk about the 4% rule, that was done with the 60/40 portfolio.
Correct.
So the rule is, you can withdraw 4% a year, retiring at like age 65 for 30 years, and typically win, right? With a 60/40 portfolio historically over time applied to broad market periods.
Mm.
The idea here is that yes, that could be correct, generally speaking, but if you're the person that's going to bail when the market's down, it might not be that might not be the case. Or maybe you're also maybe a person that's just, hey, I want to spend every single dollar that I can spend. I want to leave zero dollars
$0.
and I want to bounce the check to the morgue.
Yeah.
You know what I mean? Like, I want to bounce the check to the funeral home. That's what you're looking to
I
do.
want to
That's
enjoy
your
every
goal.
dollar I earn.
Yeah, yeah.
Yeah.
So for in that case, it might actually make sense for like a single pay annuity, like single premium.
So you know exactly what you
Yeah,
got.
yeah, yeah.
Yeah. Yeah. Okay. So then, last specific question I have here is, let's say that I'm coming to you and we've agreed that we do need to change the allocation of my, current portfolio.
Okay.
Is this something that we would do gradually? Is it something that should happen immediately? Like, let's say I'm going from 80/20 to 60/40. Do I immediately just switch that 20% swing? Or is this something that,
This gets into a timing the market question. Like, it unfortunately does. So if the market were at a high, like if we were talking today, we would probably say go ahead and do it, to be honest with you. The market is, I mean, there you could talk to 10 different analysts and get 10 different opinions
yeah,
right now as to
exactly.
whether or not, Nvidia is under or overvalued, and where the US is, and whether this AI, boom is warranted, and how to what extent that's true. Anyway, the idea is that we would want to talk about, like, for you, what are the how are you going to be impacted by the decisions that we're making? If we're talking about going from 80/20 to, what do we say, 60/40?
60/40, yeah.
Okay. Then why are we going there? Like, what is happening? Like, did your risk tolerance actually change overnight? Do we need to move there over time? Like, are you comfortable?
And maybe
riding this wave, how
I'm
you
65 and that's what we're supposed to do when we retire.
well, that's the thing. We just reject that premise.
Right.
There is no supposed to do when we retire, right? Like we need to know whether or not we need the 40% to supplement our income stream. Is the 40% going to provide that $70,000 that we talked about? And that's why we need it to be 40%? Or could we get that elsewhere? Are we going to have like an equity exposure that's going to maybe provide 1, 2% so we can get a little bit less from our bonds? We're going to have to look at the portfolio, look at the income generated because we think of, I think we've said that before, but we think of retirement as like income produced, right? So we want our assets that we own in retirement to produce some kind of income, and we feel more comfortable if you're able to provide for your income stream without having to like sell and rebalance. If that's what your risk tolerance would indicate.
Exactly.
Does that make sense? So like, not everybody's going to be happy to sell stocks in down market, like you know what I mean? Like we wouldn't want that to happen. Like
Correct.
you would sell to rebalance anyway, right? So if we're saying we agree on a 60-40 portfolio, stocks go up to 70 and bonds go down to 30, we're going to sell the equity portion to try to nudge that back
Correct.
down, and then therefore the bonds back up because there's going to
Correct.
be less total value in equities, right? So you're going to have lower total value in portfolio, but lower in stock.
And I think that that's what a big part is too, though. I think that, once people know I'm 80-20 or I'm 90-10, depending upon how familiar you are with the financial industry or what's going on or how involved you are, um, you may have no idea that there's constant rebalancing that's happening.
Right.
So you may be wary about shifting your allocation without realizing that that's happening to bring it back to where you were initially. So like
Mhm.
there's constantly a flux there.
Right, and we're going to talk about keeping, at least a couple years of income in liquid funds, like a money market or a high yield savings account or something like that, where we're not going to have to sell in a down market
Yeah. Something
unless you
excessive.
really are you just have the appetite for risk. But even then, it's kind of imprudent to go all in, in equity markets. If somebody came to us and said, like, I want to be 100% equities, and here's the income stream that I need. My equities are producing almost nothing, right? Like now produce like 200K of income just from selling equities,
Right.
and I want to be 100%. We'd probably push back on that idea a little bit. A little
Slightly.
bit, right?
Slightly.
So like, I mean, I don't think it's like there are a number of strategies that would be on the table then, and like we were talking about earlier, the SPIA or like single premium immediate annuity, which is like I give somebody a large amount of money, and then they give me smaller amounts of money every month, but it's guaranteed, right? It's insured, like it's an insurance, it's a stream of payments
Yeah.
for the rest of my life.
Yeah.
So
And then you
love
get your
annuities, but
monies.
if you're just looking to like min max or for like how much of a return can I get for my dollars,
Right.
so that I can spend them, it tends to be one of the more
Right.
favorable ways to do it.
If
Right.
you're like, I don't care at all what happens after I die.
Right. I want zero
Right.
balance to be left to
Right.
everybody else.
Right.
Right. I'm interested in me and my spending and my living and quality of life while I'm here.
Correct.
And that's fine. That's your prerogative. It's your money. You
Correct.
do what you want. Then we would talk about how we would, want to make the largest stream of payments
Right.
we can and then just spend them.
Correct. Whereas that would very much not be in the recommendations for someone looking to leave a legacy
Exactly.
for
Correct.
kids.
Exactly correct.
So
No,
it is,
not at all.
and that's I think the biggest takeaway from this, and from honestly all of the pieces of the retirement series, is that
Yeah.
there are lots and lots of things to consider, and they all are and should be highly individualized.
Exactly correct.
Yeah.
All right. Well, if you enjoyed today's episode, please review the show. And if you have any topics you'd like discussed or questions you would like answered, please reach out to us at podcast@equilibriumfp.com or visit our website at equilibriumfp.com.
Yeah. Till next time.
Thanks, guys.